hand over now to Nick to present his presentation. As I said, we will do Q&A at the end. If I do see an important question on the way, then I will butt in and see if we can take the question at the time. But do write your questions so that you know them and don't forget them, and we'll have chance to speak do them at the end. So I'm going to mute myself and Nick will carry on. Thank you, Nick.
Thanks very much, Clive. Yeah, I think, well, Clive's explained exactly what I do. Mostly advisory work and property incorporations is one of the things I advise on fairly regularly. And I think I'll go hopefully from right the way from the basics all the way to some slightly more technical but hopefully understandable points in terms of structuring a business, whether that be unincorporated or incorporated, and I think hopefully give some of the key messages of what can be done, what can't be done, and the best way for structuring a property business, because there is no one right answer across the board. What's absolutely without doubt is some structures or some individuals will find an unincorporated business structure will work just as good, if not better, than an incorporated structure. So, and there's been an awful lot in the press over the last 6 months, or well, at least in the tax press over the last 6 months or so, in terms of a variety of tax avoidance schemes that involve property incorporation. So I'll touch briefly on those as well. As I say, I'm director of Jones Miller Specialist Tax. My LinkedIn page is there as well. If you want to connect with me, please do. And I always welcome any questions. There's also I'm a host of a LinkedIn page group. I think it's technically a group, which is kind of a tax collaboration. So for any tax people out there who actually want to have a look at that, kind of encouraging everybody, accountants, tax people, to raise any questions, and basically building a community without feeling the need to be feeling like you're asking silly questions and things. So feel free to connect there as well. Right, for some reason it's not wanting to move on. That's pretty much me there. So to start out with some of the basics, I typically ring fence property businesses into 4 different types of business, and we'll be talking about the various types throughout, probably focusing mainly on the first one there, which is the residential buy-to-lets. That's where the planning on incorporation seems to be the most popular, and for obvious reasons, things like the finance cost restriction for unincorporated businesses, but there's also things to focus on when you're incorporated as well, such as the annual tax on envelope dwellings, and companies suffer an SDLT surcharge just as individuals do if they're buying more, or if they've already got owner property. So there's residential buy-to-lets. There's furnished holiday lets, which are the tax legislation in 90% of cases recognises it as an entirely separate business to a residential letting business. There's very strict conditions, and I'm not really planning on looking into FHLs too much today, but they do have, if you meet those conditions, which is things like you need to rent them out for a certain certain period of time in the year, that needs to be available to let to the general public, and it needs to be done on short-term basis, is the lettings. So if you are doing holiday letting, then there's, in most areas of the tax legislation, actually treat that as a trade, which is quite unusual for a property letting business. And as you can see there's other things there, other benefits of doing an FHL business, including not having the finance cost restriction. So as I say, in terms of the tax planning, actually because it's treated as a trade and you get a lot of tax benefits things like if you were to sell the whole business, you might, or even a part of the business technically, you might benefit from a 10% capital gains rate. You can gift properties, and it's because it's trading, you get gift relief, things like that. So in terms of the property planning that we do, actually, that's arguably the easier planning because it benefits from so many of the reliefs. The third type there is commercial rentals. Again, there's some benefits. I mean, it's an entirely different type of business, a commercial rental to a residential. And there's, again, things like the finance cost restriction doesn't apply to commercials, neither does the ATED or the SDLT surcharges. So, you know, again, we'll talk about that there. Although you've got those restrictions on residentials that you don't necessarily have on commercials, other areas of the tax legislation still consider that to be simply property investment and not trading. So your two boxes on the left on your screen there are very much property investment activities. 2 boxes on the right, we've got the furnished holiday lets, which are trading, and the final one is property development. Again, it's a very different type of business, actually building houses or refurbishing them to just renting them out. And for that reason, many areas of the tax legislation treat that as a trade as well. So various reliefs being available. So I thought it's just important.
I'll just come in there very, very briefly, because I know that some people watching this webinar will just benefit from this comment. Residential buy-to-lets would also include HMOs, houses of multiple occupation. Furnished holiday lets would also include what we call serviced accommodation, as long as it fulfills those days and rules. Serviced accommodation would be classed as furnished holiday lets. I hope you agree with that, Nick.
Yeah, absolutely. The one thing I didn't mention there, and again, I don't want to spend too much time on this because there's so much else to cover, but for furnished holiday lets, if you're doing UK and overseas, you have to treat those as 2 separate businesses, which can get interesting, where you think of things like if you've got one UK FHL business in profit, one in the overseas one in losses, then there you can't relieve costs between the 2 types of businesses. UK and overseas FHLs are, for tax purposes, 2 separate businesses. So as you can see, there's quite a lot. I mean, this isn't even a comprehensive list, but this is a summary table of the types of taxes that you're exposed to, depending on whether you're owning the properties personally or whether you acquire them in a company. The income or the profits will be subject as an unincorporated business to income tax, and your standard income tax bands are 20%, 40% and 45%, whereas a company is either 19 or 25%, depending on the size of the profits. And that applies to both residential and commercial property in both cases. When you come to sell a property, if you own it personally, residential properties still have an 18 and 28% capital gains tax band. Now, for most other gains, the tax rates of 18 and 20% were reduced to 10 and 20% quite a few years ago, actually now. But residentials remained at 18 and 28%. They were not reduced as well, and that continues to be the case. Commercial properties, on the other hand, is 10 and 20%. As you can see there, the FHLs could qualify for 10% BADR, but you need to be careful that to get 10% tax rate, if you're selling a single furnished holiday let, you technically have to sell a part of a business. You can't just sell one property unless you can justify that as a genuine part of the business. So again, some tax planning needs to be done there to make sure that you can qualify. Again, corporates, companies only pay either 19 or 25%. So even though this is a capital disposal on selling a property, they still pay 19 or 25% depending on their tax, the level of profits. Stamp duty, land tax, residential properties for both, really. I mean, most people investing in acquiring a property investment probably already have their own home and therefore will be subject to a surcharge. And companies are always subject to a surcharge, even on their first property acquisition. No such surcharge on SDLT, sorry, on commercial properties. One of the big questions we get on property one of the big reasons we get for property incorporation is that finance costs on residential properties, if you own them personally, you only get basic rate relief. I've got a variety of clients. Some clients are already basic rate taxpayers, and actually the finance costs don't really affect them. But if you've got some significant mortgages on your property and you're a higher rate taxpayer, then it's worth at least looking at the tax calculations, which I'll come on to see the types of savings you'll get as a corporate. Commercials don't have a finance cost restriction, and companies aren't subject in either case to a restriction. The other point is IHT. Not really my area, but it's I think fairly straightforward on property, which is if you're doing property investment, you're not going to get any relief. If you've got residential and commercial property, so there's no business property relief. The one thing is that you will have a rebasing of those properties for capital gains tax purposes on death. But obviously that means either you need the property to fall within your nil rate band, or you're going to have a 40% IHT charge. So and that's another area of planning that I do get involved with people wanting to effectively transfer some wealth out of their estate, because obviously with the increase in property values, there's plenty of people who have been invested in property for a number of years and all of a sudden do have an IHT exposure. So that's another thing to be aware of. I don't want to spend very long on these income tax. They're fairly basic, but just to kind of cover them, because that will lead into some of the calculations. So if you are an individual owning property, you can see the personal tax bands there. So you've got a personal allowance 12,570, basic rate band goes up to 50,270, where you pay at 20%. In the last budget, they reduced the higher rate threshold, so that now finishes at 125,140, and above that you'll pay 45%. And when we're talking about property, there are some property investors out there who do this as pretty much their full-time job. But if you're doing property investment as a bit of a side hustle, if you like, then you've probably also got a job or self-employed or some sort of other income, which will also use up those bands. So it's important to be aware that all of your income gets pulled together when we consider what band each income, what the income falls into. So you might well end up paying some within your personal allowance at 0, a further amount at 20%, and then the rest at 40%. So for people getting into property investment who might have been employed up until this point and not therefore used to filing tax returns, I've just put this slide on here because I think it's quite important to be aware of when it comes to cash flow. So if you are now owning property, you need to register for self-assessment in most cases, because you need to tell HMRC about your income and your profits. So the deadline for that is the 5th of October, after the end of the tax year, when you first start making a profit. So if you start property investment in any time up to the 5th of April 2024, you need to be registering by the 5th of October 24. The biggest thing for people to be aware of who are new to self-assessment is payments on account. If your tax liability when you come to do your tax return is more than £1,000, that includes class 4, but that's only if you're self-employed, not property investment in general. But if it's more than £1,000, you fall into this payments on account regime. And what that means is HMRC will ask you for 50% of the tax bill towards next year. So they're effectively trying to spread it out over 2 payments. So you end up paying 50% of your tax bill in January and another 50% in July. And if it's fairly consistent and even after the first couple of years, that's not really much of an issue. But in year one, or the first year you fall above the £1,000 threshold in interpayments on account, what you end up doing, you pay your tax bill for the year just gone, plus you have to pay 50% towards next year. So, and it's estimated based on last year's profits. So if your profits are expected to go down, then you can actually say, I'm expecting them to go down. This is my estimate. This is how much payments on account I should make. But the most important thing from a cash flow perspective is you are paying potentially 150% of the tax bill as soon as you fall into payments on account. So just something to watch out for there. So we've talked about the types of property investment, or at least how we categorize it in most of the tax legislation. Now we look at the types of business entities that you can set up. We've excuse me. We've got sole ownership, where you as an individual own 100% of the property. We've got a partnership where maybe you own it jointly with another individual, either a spouse or it can be anybody, a family member, or even a third party. We'll come on briefly to the technicalities of what a partnership is, because there is technically a difference between just joint ownership and a genuine partnership, and that's important for incorporation. But for now, let's just call it a partnership. And then obviously, as we've talked about, you can also operate as a limited company. This slide is obviously a very general type of slide, but I think it's interesting to see that what we tend to advise when we're asked the types of questions as a general rule of thumb. So the next few slides assumes there's no other income. If there is other income, then, as I said at the start, this is really a case-by-case basis. You need to look at the calculations each time. But if your profits are going to be less than 50,000, essentially you're a basic rate taxpayer. Actually, sole ownership is probably the best route to go. You could look at a partnership or joint ownership to split income, especially if your spouse has a lower income as well. If your profits are between 50 and 100,000, that's when we start to the tax planning can become a bit more valuable. Again, sole ownership or partnership could well still be your best choice, especially if you're making profits of 100,000 and there's no other income and you're splitting that with a spouse. You're still both basic rate taxpayers. And again, limited company can be. I generally don't think it's that important in terms of the limited liability side of things, but perhaps more so in the property development world. Profits expected to be more than 50,000, but you also want to, and this is where the value of limited companies comes in, you want to leave money in there to grow or to reinvest. Because more than 50,000, you're paying at the higher rate income tax bill, so that's 40 or 45%. A limited company will be paying 19 to 25%. So if you don't need to extract it, and because when you're extracting cash, you then got to pay income tax on it. If you're leaving it in the company and only paying 19 or 25%, then you've essentially got another 20% that you could use to reinvest some funds into perhaps a new property acquisition. So that's where a limited company might be valuable. If you're more than £100,000 per annum, but you're still going to need all that money to live off, when you do the calculations, even a sole ownership might still be preferable. So, as I say, even at those levels, and there is actually, it obviously changes every time they change the thresholds, but there is actually a point where it goes from sole ownership is best to limited company is best, and when you get super high, actually sole ownership becomes best again. So it's a bit of a strange one how the numbers work sometimes, but just important to be aware that just looking at the profits of a property business doesn't mean there's one best option. And then another thing I get quite heavily involved with is estate planning in terms of what we can do with shares in limited companies. And that's where we can perhaps be talking about passing wealth down to children and grandchildren. Salary versus dividends is also another one. When you are operating through a company, how much salary should you take versus how much dividends? Because a salary is taxable at 20 or 40% for basic rate, higher rate, but it's deductible for corporation tax. A dividend benefits from lower tax rates. You can see there 8.75% for basic rate taxpayers, whereas there's no corporation tax deduction for dividends. So again, running the numbers, there's calculators out there, quite a lot of free calculators available, and they're worth it's worth putting the time in to actually see what the best route is, especially when we're talking property and you've got other income to consider as well. So I've put together a few examples. So the first one is a 23-24 tax rates. Profits of the business are £100,000. The plan is to run the business for 10 years, make as much money as you can, and then sell. You need £50,000 to live off, and you're going to split that between salary and dividends because there's no other income, which means that the dividends can benefit from the 8.75% tax band. This assumes that you start the business in 23-24. So the first thing to look at is, okay, what tax do you pay as a company? So we've taken a £12,570 salary, so that gets tax deduction, but it's within our personal allowance, so there's no income tax either. And that means that the taxable profits are just under 88,000, so the company pays £19,418 in tax. As you can see there, as I just said, salary, first 12,570 gets zero tax. You get a dividend allowance of £8,000, so that's at 0%, and then the balance 8.75%. If we have a look at what happens when you sell the company, you have final sales proceeds from the company, because as I said, you've been making 100,000 and you've been retaining 50,000. You then sell the business for a million, and you end up with final proceeds of just over 1.3. This is on the assumption that you are selling the company, and in many cases it is possible to find a buyer to buy company because they don't want to pay SDLT. If you buy the shares of the company as the buyer, you only pay 0.5% in stamp duty instead. So it's quite possible that might happen. The capital gains tax bill on that, we don't get business asset disposal relief, so we have to pay at 20%. So in a property investment business, so 260,000, and we have net proceeds of 1,042,000 over that 10-year period. Now let me just jump back to actually what's on this slide here. In sole ownership, income tax to 27,432, whereas if we look here, we've got a slight tax saving per year of 4,800. And I think what's important to look at here, we're talking, I think for a lot of property businesses, £100,000 profit, you're quite a sizable business. And we're talking about if you're already owning these properties, you could say £4,800 a year. Actually, when we come on to incorporation, unless there's a way to incorporate without paying any tax, then the costs of incorporating a property portfolio to save under 5,000 a year are probably not going to make it a worthwhile venture. So, well, a worthwhile transaction to incorporate. And I think that's a really key message to get across. There's only limited circumstances that you can incorporate completely tax-free, and actually the savings might be quite quite minimal anyway. And therefore, one of the messages is, if you can start from day one in a company and you know a company structure is the best way for you, do it from day one. Even if you sort of bought it personally and thought, I'm going to incorporate on the next day, technically there's still an SDLT charge, so you're paying twice. To have a look at a partnership example, I've got two examples here. One's if you're making profits of 50,000, one's if you're making 100,000. So if we look at as a £50,000 property business, as a sole trader, you would pay income tax of 7,486 and end up with just over 42,000 after tax cash. If you were to split that 50-50 with somebody and you're both basic rate taxpayers, you would save £2,500 or just over 2,500. If we look at a property business that's making 100,000, that's where the numbers start to ramp up, because we're into the, as a sole owner, we're into a 40% tax band. So your income tax bill is 27,432. If you split that 50-50, you're both basic rate again. So the saving as a partnership is £12,460. So just being a partnership, it can be very beneficial. And the other thing to note, when it's easier to do when we're talking about spouses, because gifts between spouses for capital gains tax purposes are tax-free. So you can gift a 50% share in a property without paying any tax. If you want to give them to anybody else, even family members, there's potential tax liabilities to be concerned about, which is why we commonly talk about partnerships and 50-50 joint ownership with spouses. So to look at this was actually interesting. When I was updating these numbers, they fly around depending on the circumstances, and that's kind of the main message I wanted to get across here. So if we look at a limited company over 10 years, based on the numbers I've been talking about, we've got tax on profit of 194,000. Extracting the income, you've paid dividend tax of 32,000. You've sold it at the end for £1 million. And you've paid capital gains tax of 260,000. So your total tax due as a limited company, 486, versus as a sole owner. I'm used to saying sole trader when actually I'm very careful when we're talking about property, because you're not trading. So I say sole owner and sometimes trip myself up thinking sole trader. But tax on profits as a sole owner over 10 years would be 274,000 approximately. You would pay 28% capital gains tax on the sale of residential property, so 280,000. And so your tax due in that example is 554. So as a limited company over our 10-year period, remember, we've actually rolled up £50,000 so that we've extracted it at the end at 20% instead of 40% higher rate tax. We've saved £67,406 over that 10-year period. I then did another example and said, what if the commercial property, what if the properties were commercial rather than residential? And because we're now paying 20% capital gains and we're not paying 28% on the exit, actually the commercial property, the sole ownership was the better route to go, with a saving of 12,594. So it's interesting that just whether it's residential or commercial can affect which is the best way to go. And I think it's also worth bearing in mind here, we're talking about an exit here. A lot of the time people come and say we're investing in property because we're looking to build an estate, build a portfolio. We're not looking at an exit strategy. They might even be talking about passing it down to family members. So these examples only really apply when we can really value the limited company with capital gains extraction at the end as well. I did just want to touch on furnished holiday lets here as well, because one of the big things, as I said, when we were comparing the types of property businesses, is that FHL can benefit from the 10% capital gains tax rate. The saving is by far much smaller than under a residential portfolio, but there is still just about a tax saving. But bearing in mind, we've over the 10 years, as a limited company, we've saved ourselves £17,000. And if we actually think about what does it actually cost to run a limited company, paying somebody to actually file accounts, possibly, well, you will need to file accounts, but whether you need to pay an accountant or do it yourself. So actually £17,000 tax saving will be even lower when you start to consider what professional fees you have to pay to be operating a limited company. So I thought that's quite an interesting one as well. An FHL business really isn't a great saving. So that kind of explains, and hopefully the biggest message of that is you've really got to look on a case-by-case basis. What are they investing in, or what activity are they doing? What other income have they got? You can only really run the numbers on a case-by-case basis. You can't just say, if you're over this level of profits, corporate all the way. That's kind of hopefully the key message I've managed to get across there. A lot of the work, as I said, that we do is actually on incorporating an existing portfolio. And a lot of the tax planning hinges on what a business is. So I wanted to run through some of these cases. There are a couple of VAT cases that talk about what a business is. So when we are doing our planning, we kind of look at all the types of tax cases that have been out there, because business isn't defined in the legislation anywhere, and yet the legislation uses the word business a lot. So we can all call something we're doing this as a business, but actually when things have gone in front of the courts, what have the courts decided when HMRC have said, yes, this isn't a business, you can't get relief because all you're doing is property investment, and the taxpayer said, yeah, of course I'm doing enough activity to justify I'm running this as a genuine business and therefore should get relief. So there's plenty of cases that have gone before the courts. HMRC have changed their attitude, well, haven't changed their attitude, but they've updated their guidance for VAT and what a business is. They did that in June 2022, and there's now, I guess, 2 lead cases on the subject, which is Wakefield College and Longbridge-on-Thames. I don't want to go into too much detail on this. The point is, when we are talking about businesses, most of the court cases that are analysing how much activity is actually done, and activity is a really key point here. So if all you're doing is you buy a property, you ask a letting agent to manage it for you, they do all the work, you're not really doing anything other than putting some money into a property and letting someone else do it. So you're not being active in that business, and therefore for tax purposes you're not really running a business, you're just operating a property investment portfolio. As you can see there, there's various things that were kind of analysed through these cases. Are you actually out there to make income, or are you out there to make a profit? And would you believe actually that was quite a key factor in one of these cases as well. But the point is, we really need to be doing being quite active, and that's what one of the capital gains cases, or probably one of the most popular capital gains cases to be cited when we're talking about incorporation, is a lady called Elizabeth Ramsey. I think this one's interesting for a few reasons. The first is we're talking about incorporating a single apartment block. So you could say, well, she's only got one property or apartment block. Is she really a big enough? Is she big enough to actually call herself a business? Because I'll come on to incorporation relief. You need to be operating a business to get capital gains tax relief, which is why the courts were trying to decide whether she was operating a business. At the first tier tribunal, they actually said, no, you're not operating a business. You're just running a property investment portfolio, and what you're doing is just normal and incidental to having to run a property investment portfolio. So you're not a business, you can't get capital gains tax relief when you move them into a company. This then went on appeal to the upper tribunal, and the upper tribunal disagreed with the first tier tribunal. They said that, I think, and what is very commonly cited when we're talking about incorporation cases, that Elizabeth Ramsey was spending 20 hours a week managing those properties. She hadn't left that to an to a letting agent. She was actually going out dealing with repairs and maintenance. These were all self-contained flats with some communal areas. And so she physically operated this as a business according to the courts, because she spent 20 hours a week. And that seems to have become a rule of thumb, even to the point that HMRC have put Elizabeth Ramsey in 20 hours a week in their manuals. So HMRC manuals are something you can go to, which are technically HMRC released to the public, but it's for the inspectors to read and understand what HMRC policy is on interpreting legislation. So HMRC policy is, if a person is spending 20 hours a week managing a property business, they can usually accept that that is a genuine business. And if it's less than 20 hours a week, then HMRC are going to look a lot more closely at what you're doing and how you're operating to justify being a business. So when we come to incorporating property partnerships, and it's important, I'm only talking about partnerships here, I'm not talking about sole owners. Again, to be able to incorporate a property business without paying SDLT, there's two things. You have to be operating a business. As I've briefly explained there needs to be enough activity to justify a business. And you have to be operating a partnership. So, and that's why I was trying to be a bit careful earlier on, talking about a partnership versus just joint ownership. There is a distinction for SDLT purposes. Simple joint ownership is not enough to be able to incorporate jointly owned businesses SDLT free. So there's an awful lot of technicalities here, and whenever we're analysing this for a client, basically we're having to draw on case law, see what examples have gone to the courts, what have the courts refused, what have the courts accepted, because, you know, unless it's quite clear. And I do have clients who, you know, they've been, one example of a client has their property portfolio value is about 30 million, and there's about 15 million pounds worth of debt there, but they are business partners. All they've done for the last 30 years is run a property portfolio. There's two guys, one of them's been going out and about actually doing the repairs like Elizabeth Ramsey was doing. He's kind of the handyman of the business. The other one's actually effectively been acting as the letting agent, actually dealing with the admin side of things. So in their case, I think it's absolutely clear they are genuinely in partnership and running a business. But I would probably say 9 out of 10 cases are not that clear cut, and probably another 8 out of 10 just simply aren't doing enough to operate a business. So yeah, the word business and the phrase activity is absolutely crucial when we're talking about whether we can incorporate without paying any tax. And I've actually put the quote in there from HMRC's manual if you did want to go and look it up and do a bit more research on it. And they do specifically say you should accept incorporation relief is available if the individual, and bear in mind that says individual, so each person who is involved in this business needs to be doing 20 hours a week, undertaking the sort of activities indicative of a business. And there it says other cases need to be considered carefully. And again, they also say third-party management agents, that's not a part of those 20 hours. You have to physically be doing those hours yourself. And so when it comes to these cases, especially borderline cases, the more kind of proof you can do that you are doing this much work you know, the amount of emails and phone calls you're making, that type of thing, all supports your case. So how do we incorporate if we are a sole owner? I mean, all of property portfolios can incorporate, and we've seen the types of tax savings they might get, especially on sort of small to medium portfolios, aren't huge. So is it really worth a sole owner incorporating? Let's assume that they do get a tax saving if they operate as a company. So to do it, they're firstly technically selling their properties to the company, because the company is a complete, even though they own 100% of it, it's a completely separate legal entity. So for capital gains says you are making a disposal. As you're making a disposal, and it's almost HMRC having their cake and eat it here, because we're saying you are making a disposal, but because you own the company, not only are you making a disposal, with HMRC, or not HMRC, actually the tax legislation deems you to make that disposal at market value. So whatever you bought the properties for, even if you just transfer them and don't technically sell for any proceeds, that doesn't matter. Whatever your properties are worth today is what your capital gains tax pages on your self-assessment need to say proceeds. So let's assume you bought properties for 500,000 and now they're worth 2 million. You have sold them to a company for deemed proceeds, even if you've not had it, of £2 million. You've paid 500,000, so you've got a base cost, but you've got a £1.5 million gain. So can you get any relief for that? There's two types of relief in general when we're incorporating any kind of business. The first is gift relief. If you just say, I'm gifting these, I'm not having any proceeds, I own the company, and therefore I shouldn't pay any tax. Well, unless you're operating a furnished holiday let, and this is where I said at the start, they do benefit from quite a few reliefs. You can only get gift relief if you're trading. FHL can technically, for tax purposes, be trading. Commercial and residential buy-to-lets are not trading. And again, this is another term. This isn't what I'm talking about being a business. You have to be specifically trading. Trading is normally thought of, you know, manufacturing activities or retail. That type of thing is obviously trading. FHLs have a specific exemption that says you can treat them as trading businesses. All other types of property investment is not trading. Property development is different again. As I said, property development is actually technically a trade for tax purposes, and therefore gift relief might be possible there. So in most cases, when we're talking about incorporating properties, we can't get gift relief. Can we get incorporation relief? That all hinges on what I've just been talking about. You have to be operating a business, not just operating a property investment portfolio. So you need to be very active. You need to be spending ideally minimum 20 hours a week in actually running it. So the odd 1 or 2 properties is unlikely in a lot of cases to qualify. And therefore, in a large number of sole owned property portfolios, you cannot get capital gains tax relief going in which case, if they are standing at a gain, then that probably will wipe out the savings that you were hoping to get from income tax and under a company. There's a few examples where you might have a base cost equivalent to the current value. For instance, if you have just inherited the property portfolio, then on death, capital gains tax base rates are rebased. So that might be an example of where capital gains might not be a problem. For sole businesses, though, SDLT is always a problem. Again, the tax rules say you're selling this to a connected person. So whatever you sell it for, even if it's zero, SDLT says you have to pay it based on the market value. There is no exemption from that. So there are a few reliefs that might be available to reduce that, but in most cases you are going to pay some SDLT. I've listed the types of reliefs that might be available. So the multiple dwellings relief may be, if you're incorporating more than 6, that's probably one of the better examples for property incorporations. Then you can use non-residential rates. But even then, obviously, non-residential rates is potentially on SDLT market value, still going to be quite a hefty SDLT charge. So I would say 9 out of 10 sole-owned property portfolios are going to pay both capital gains tax and SDLT, and that's where my conversation ends with most clients. Partnerships. This is where we can get a little bit more interested, I guess, as advisors, as to whether there's any opportunities, and it kind of depends which advisor you talk to. All I will say is please speak to somebody who is a qualified tax advisor or qualified accountant, because there's been at least 2, I think they call themselves property advisors, that have come up with various schemes, and they've been completely debunked. HMRC themselves have published something called Spotlight 63, which is basically spotlights kind of where they say we're aware of this type of tax planning and this is why we think it doesn't work. So there I've said no, run for the hills, it does not work. And actually in these cases, not only does it not work, HMRC say those specific schemes you need to report under something called DOTAS. So any accountant who is qualified is probably going to run a mile from wanting to act for you if you are involved in a DOTAS reportable scheme, because that means that the accountant has to tell HMRC they are acting for a client who has a scheme that needs to be registered, and they're not going to want HMRC on their backs like that. So DOTAS means disclosure of tax avoidance schemes. So those really, some of those schemes are not only concerning from a tax perspective that they don't work. We've had people come to us saying, can we unwind it? And in most cases, the answer is only if you've done something wrong legally and you couldn't actually, and your legal paperwork wasn't correct, and therefore we can say that the incorporation never happened. Otherwise, not only do you suffer the tax bill going in, but if you want to unwind it and come out, you got another tax bill. So they are really dangerous, I think. And some of those cases have also relied on something called a bare trust, where they don't physically move the property in terms of, they don't go to the land registry and say this is now owned by a company. They just write a legal agreement that says the company holds it as the beneficial owner. And the problem there is, other than the tax issues, which you still have, you also potentially, and this is what got quite a lot of press as well, you also potentially have a problem if you've got mortgages, because you have to tell the bank, or at least most people other than the scheme promoters themselves think you need to tell the bank. And if you don't, potentially that causes a default on your mortgage. It could also mean that your insurance is in default as well, and therefore you can't claim on your insurance. So yeah, there's something I would absolutely, I could talk to you all day about not getting involved in anything like that. So that's the really horrible ones that you know, people have had advice, they seem like they know what they're talking about. They've even claimed to have barristers' opinions, which isn't actually a barrister's opinion on the whole scheme, it's on one specific thing. And therefore they seem credible, when actually it's all now coming and biting a lot of people. So yeah, be aware. There's, I guess you'd call it a middle ground. I don't like these. I don't advise on them. I still think they're dangerous. But I do get people come to me and say, well, someone's told me I can, if I transfer to an LLP, then I can incorporate it in a couple of years' time. So the idea behind this planning is, even if you're not technically a partnership, you're just joint owners, and you move your properties into an LLP. LLP means limited liability partnership. So it's still a partnership, but you kind of have the limited liability that companies enjoy. So from a legal perspective, there's things like it needs to be registered at Companies House. It's a legal partnership. So it has the benefit that you can say you are quite genuinely a partnership for SDLT planning, which is good. The problem is you can transfer to an LLP. LLPs for tax purposes are transparent. They're the same as unincorporated businesses. So there's no tax charges going in there. We then incorporate in a couple of years down the line. And because we're a partnership, we can say we can get incorporation relief and we won't pay any SDLT. And I'll come on to the reasons why for that. The problem is the anti-avoidance rules in the SDLT legislation say, unless you've got two genuine commercial reasons for doing step 1 and step 2, LLP is step 1, incorporating to company is step 2, then they can apply anti-avoidance and completely unwind the whole thing. So you're back to you're paying potentially CGT and SDLT. And the reasons why people say just leave it 2 or 3 years is not because that makes it an acceptable tax planning, let's call it a scheme. It's because hopefully after 2 or 3 years, HMRC aren't going to spot it. So they're just relying on HMRC not going back. In theory, you could leave 10 years, HMRC come and say the only if HMRC get evidence that you had some tax planning advice that said do this, and then 10 years down the line you can incorporate, you've got no problem. Then they can still link it under the anti-avoidance, and you can still be charged SDLT in both cases. So that's the reason I don't touch that type of planning. I don't think it works. It effectively relies on the passage of time, meaning you don't HMRC don't catch you out. The work that we do is looking at a property portfolio and looking at whether it genuinely is a business, and therefore are we doing sufficient activity, which is what I've been talking about, to be able to justify to HMRC that those reliefs will be available. And the problem is, and why people pay us to give them this advice that they can rely on and therefore sue us if we get it wrong, we can't go to HMRC for clearance for this. There's no pre-transaction clearance. So, if HMRC did want to question it, we're kind of putting ourselves on the line by saying we gave advice in writing. Here's our nice glossy report that says these are all the reasons we think it's a business. So the first step is, hopefully, if HMRC does inquire, the taxpayer can just say, look, here's a 20-page report that we had and all the reasons why we did it, and hopefully that's enough to end the inquiry. HMRC say fair enough. And well, we've not had HMRC come back and refuse any kind of claim there, because we like to at least, if someone's not quite there, we will tell someone they're not quite there, and we don't think they will get incorporation relief. So, can we incorporate a partnership and get capital gains tax relief? Again, I've put the a brief description of what the rules are to incorporate without CGT. And you can see there, it needs to be a business operated as a going concern. The other thing is it needs to be in exchange for shares. So what you do, you say, I've got a £2 million property portfolio. I'm selling it to a company. In exchange for those properties, the company is issuing me with shares. So that's fine. And we normally don't have a problem with that, as long as we can be happy we've got a sufficient activity to be a business. The other thing is we have to transfer all assets. So you can't say, I've got a business on the balance sheet, I've got 6 properties, I only want to transfer 5 and keep 1 personally. It's all or nothing. You might be able to buy an asset out of your business first, but for incorporation relief, let's keep it simple for now, you have to transfer everything. You can buy concession. The rules say nothing about whether if you've got mortgages on your properties, it doesn't say anything about your mortgages, but HMRC basically say, Ian, if you have got mortgages, we'll allow those to be transferred over without incurring a tax liability. So there's two things about incorporation relief. Firstly, if you do qualify, you don't pay capital gains tax going in. The second thing, the gain, let's use my £2 million example where we had a £500 base cost. You got £1.5 million gain. That moves into your shares. So if you sell your shares in the future, you've effectively got no base cost, and you're going to pay tax on the full gain. But if the company sells the properties, the company has acquired those properties for £2 million. So if the company decides to sell them in 6 months' time for £2 million, it pays no corporation tax, and all the cash is in the company. That's just something to be aware of, that actually it does give the company a rebasing. I've mentioned gift relief briefly. Same rules apply whether you're a partnership or sole owned. You still have to be operating a trade, and therefore you still need a furnished holiday let business in reality, or a property development business. SDLT is where it gets really fun. So again, we've already talked about that. If you're transferring any kind of property business, you're deemed to be paying market value. Where partnerships benefit for SDLT, this isn't a relief, this is just the way it's done. This is how you calculate SDLT when you are transferring a partnership to a company. It's called the sum of lower proportions. HMRC have a manual on it, which actually I think is quite good, and it's 9 or 10 step calculation that you have to go through. But the long and short of it is, if you own something, let's say 50-50, you transfer it into a company in exchange for shares, and it's still 50-50 in the company, you own the company 50-50, the sum of lower proportions will almost certainly come out as 0, which means it's saying the sum of lower proportions says this is the consideration for SDLT. So if your calculation comes out at 0, you're paying SDLT on 0. So there's no SDLT. It's not a relief, it's just how the tax rules say you determine what the consideration is. And again, if you had 4 owners as an unincorporated business, 25% each, as long as the companies own 25% each, then you've got no SDLT again. And that's why so much of our work is, are you genuinely a partnership, or are you just jointly owned owners? Let me just check the time before I keep waffling on. So again, this is where you don't technically have to be submitting partnership tax returns if you meet the definition under the Partnership Act, which is in there, which says that you are effectively operating a well, I've lost the partner, I've lost it there. But if you are operating a business together with a view to making a profit, you could still technically be deemed to be a partnership. So again, partnership tax returns are not the silver bullet. If you don't have one, plenty of incorporations have been done. If you don't have a partnership agreement, you can still technically do it, but you have to be very careful that you are absolutely sure you will meet that definition for legal purposes. So I just want to spend maybe the last 10 minutes or so before we get on to questions, talking about some of the limited company structuring, which is what I do an awful lot of. And if I look a bit tired, it's because the last 2 days I've been playing with a property portfolio demerger, where I've been splitting what has been owned by 4 individuals into 3 separate groups. And it's been absolute nightmare trying to deal with it, because these properties were bought back in the 60s. We're moving everything around, we're moving cash, and it's fun and games, shall we say. So there's a lot you can do with group structures, especially if you've been for people who have held properties in companies for many, many years. So just to kind of cover some, I'm not really sure what that title's doing there, apologies. But just to cover some of the types of things that terms you might come across when we're talking about companies and properties. SPV, it means special purpose vehicle. Doesn't mean an awful lot. It's just a company that's set up for a specific purpose. An SPV might be something that's set up for obtaining finance, or it could be something that's set up just to hold a property for a specific reason. That's all it means. It's just a generic term. It's nowhere in the tax legislation. It's just what people like to call it. Personal investment company, PIC. Generally, that's again, this isn't legislated for, it's just become a fairly common term that's used. Normally, it's one that's with a single shareholder that they've set up a company to hold a variety of investments, whether that's property investments, cash, shares, anything. PSC, personal service company. If anybody's heard of the IR35 legislation, PSC comes into that. It's a company that's set up for providing your services through. And you normally do that because you're trying to avoid being an employee. And that's why IR35 says, no, we don't like that. We're going to tax you as an employee anyway. So personal service company providing your services to another company or business. FIC, much like a personal investment company, it just means family investment company. This is where, again, it's just, there's nothing special at Companies House. It's just a company that's got different family members in. But it's good for tax planning if you're trying to pass value out of your estate to future generations, then you can do some tax planning quite legitimately to pass wealth on, and we've done some interesting cases. So those are some of the terms. How can we use companies to do some legitimate tax planning? Alphabet shares is the first thing. I think alphabet shares are very commonly advised on by most accountants, and largely just people saying, yeah, you can do A, B, C shares. It doesn't matter. You can do what you like. You can have dividend only shares. You can do this and that. Largely speaking, yes, yeah, any company can have whatever share they like. Alphabet share just means you've got different shares. So you might have 3 individuals in a company. One has an A share, one has a B share, one has a C. They can all have voting rights. They can all have capital rights. And they can all have dividend rights, or they can have a combination. So you might say, if we're talking about property and maybe a family investment group, you could say mum and dad are going to have the voting rights. They want to keep control, but we'll give the kids capital rights. And that's fine. And as long as you've got to be careful about whether you're transferring value and whether there's tax charges on that when you do it, but it's perfectly fine, especially if you're setting it up from scratch, to set it up in this way. So the main thing to be aware of is be careful when you're actually changing share structures, that you're not going to incur a tax charge when you change them. But the use of alphabet shares, it can be very, very valuable. The warnings, as I say, they're great, very flexible, can be used to pay dividends, but unless they're family members, and even family members need to be careful, unless you've got family members, giving even dividend only shares to, let's say, an employee can be subject to income tax. So just be aware that you need to make sure that there's no income tax charges when you do it. As I say, even family members, because most family members will have an exemption because there's an exemption for personal relationships. But again, you need to be absolutely sure that that applies. And the other thing is dividend only shares can be called what is, the tax legislation calls a settlement, which actually means that even if you gift a dividend only share, and it's easy for HMRC to call a settlement if you gift shares to minor children. Not quite so easy, but there's still plenty of case law that says gifting dividend only shares can be treated as a settlement. Those dividends are taxable back on the person who gifted the shares in the first place. So if you're trying to do this for tax planning purposes, be very careful that what you're doing is genuine tax planning and not going to fall foul of those types of issues. Growth and freezer shares is, I think that's becoming more and more popular. More and more people are understanding what these terms mean. And and they're widely used when we're talking about trying to pass value on to children and passing it out of your estate so you reduce your inheritance tax problems. Basically, what a growth share is, and they're issued in trading companies as well. You issue a share to an individual, but they don't have any capital rights. So let's use a £2 million example again. The company's worth £2 million. It's got ordinary shares at the moment. You issue an A ordinary share, which is your growth share. It only benefits from capital value in excess of £2 million. So if the company is sold in 5 years' time for 3 million and you've issued 20% growth share, then that shareholder will get 20% of the growth, the extra £1 million, as a capital gain. So that's what growth shares do. Freezer shares say that if the value is £2 million, the ordinary shares, we're going to freeze that value. And because we've frozen that value, if the company grows up to £3 million, they still only get their share of the 2 million. So that's why it's beneficial for estate planning. We're protecting any future growth. And why that works from a tax perspective is because we're saying we're giving someone a share that if the company grows, they can have some capital value. That's fantastic for them. If the company doesn't grow, they have nothing. And therefore, for capital gains tax purposes, you're disposing, effectively, even though you might be issuing a new share, the individual who now has 80% hasn't disposed of any capital value on day one, and that's why it works for capital gains tax purposes. And the absolute extreme that I was asked to advise another tax advisor on, who came up with a nice cunning plan, was that they basically said, okay, we've got a portfolio worth £8 million. There's a number of family members, but they're going to bring the children in. We're going to issue, we're going to freeze those existing shares. So 8 million, they still have £8 million, but we've got, if they take any dividends out, then their £8 million value goes down because they're taking money out of the existing capital value of the company. And then any excess goes to the kids who now hold these growth shares. And actually, I trawled through that and tried to come up with something to say it's not going to work. And I think it works. In reality, it sounds like a great plan, but the only way they're getting any dividends out is when they actually make money each year. So it's not going to be huge. You know, they're not going to be able to completely wipe out their estate or anything. But certainly if the property prices skyrocket, growth shares are a fantastic way to be able to pass value on. And again, if we're talking families, you can say we're not going to give the growth shares voting rights, or perhaps they only get voting rights on the death of the majority shareholder or something like that. So the control stays. So just to run through, just looking at the time again, hopefully we've not got a crazy amount of questions, because I would like to kind of cover some of these group structures. Here's a growth share, freezer share example.
Carry on, Nick. I think this
is
important, and I think that you're covering most of the questions, so no pressure.
Excellent. I won't double the speed of my talking. Right, a growth freezer share example. Let's assume we currently have two shareholders, James and Helen, 50-50, and they own a property company. I say let's assume, this is a real example that I'm currently working on. They now want to, and here's where some of the terminology comes in, they both want to hold their shares via an FIC, which is just a holding company will own 50% of PropCo and another holding company will own the other 50%. The value of having a structure where a holding company owns shares in PropCo, especially where, in my case, James and Helen are not related in any way. They've been working together for a few years, but they have their own aspirations in life. James has no kids, Helen does. So they've got their own reasons for having this portfolio. And more importantly, they've got their own desires as to whether one of them gets dividends. You know, Helen has a family. She wants some income out of this. James just wants to build up his portfolio and reinvest. Problem is, if they've got 50-50, and unless you've got Alphabet shares where you can pay dividends on one and not the other, you have to pay the dividends out. If Helen wants a dividend, James has to have it, unless he waives his right, and he's not going to waive his right, because why would he give Helen a share of the value? So the great thing about company to company, so if PropCo pays a dividend, it pays 50% of each of that dividend to James's company and Helen's. A company to company doesn't pay tax on dividends. So let's say £100,000 dividends declared, they each get £50,000. Both holding companies pay no tax. It's got £50,000. Helen can then choose to pay her £50,000 to her and pay income tax on it. James can say, I'm going to keep that £50,000 in the company. I don't need it personally. I'm going to reinvest that in my own property, in my own FIC. And obviously that's when group structures can expand and expand, but that's the great thing in this case. What they also want to do, as I say, James has no kids, but he has gone the route of having a trust as well as Helen having her trust, because it's a trust that's going to have growth shares. So any value that grows in the business goes to their respective trusts. Helen has kids who are the beneficiaries of the trust already. James has a trustee that basically says any kids that he has in the future will become the beneficiaries. And what that means is, on a £5 million value of PropCo, James has £2.5 million value, but if the company grows, all of that value is in the trusts and outside both of James and Helen's estate, which is fantastic. The other good thing about that is obviously there's no tax up front, because these growth shares have no value on day one. The one thing you need to be very, very, well, not careful of, I wouldn't say, but if you're advising clients, if you're an accountant or tax advisor, the one thing to be careful of before you go and say, look, here's a great structure that you can implement. HMRC are, it's quite difficult to get clearance from HMRC on some of these types of structures, because HMRC don't like what they consider to be extractive structures. So if you're setting up a holding company, an FIC, a PIC, just to extract dividends and not have to pay income tax on it, HMRC don't really like giving clearance. So when I say clearance, on this structure, it's something called a share for share exchange. So we're putting these FICs on top. We're not paying capital gains tax because there is specific legislation that says we don't have to. But that legislation says you only get this the share exchange relief if you are not doing this for tax avoidance purposes. And that's what we can ask HMRC before we do it. We can go to HMRC and say, look, this is the structure we want to implement it. This is why we're doing it. It's not for tax avoidance, it's commercial. James wants to grow his business. This is what his FIC is going to do, all the commercial things it's going to do. Helen has completely different aspirations. And HMRC will give us, hopefully, that clearance, as long as the commercial reasons are strong enough. But if all you're doing is we're going to put a holding company on top because we want to put dividends in there, and we've got no other commercial reason to do it, they're not going to give you clearance and it's not going to work. So why I say it's perhaps not as much of a risk is because you can ask HMRC. HMRC will tell you before you do the transaction whether they are willing to accept it's not going to incur tax to set up. And so we do a lot of that type of planning. But certainly the current clearance team, they're not particularly fond of giving clearance unless you can show really strong commercial reasons for doing it. Joint ventures, there's many types of joint ventures, whether that's as a partnership, so you can do joint ventures unincorporated. There's absolutely no problem with doing that. Most of the joint venture structures I see tend to be property development rather than property investment. So you can set up in a partnership and just have a contractual arrangement between yourselves. That's absolutely fine. And you might set up as an LLP. As I said, LLPs technically are just treated as normal partnerships for tax, but you have that liability risk reduced, which might be beneficial on property development. Most of the work I do, because I'm corporate tax, is in relation to limited company joint ventures. So you might have two companies owning another company, which we'll call JVco, 50-50, and they're going to share in the profits 50-50. One of the most recent cases I did was we had someone who was a big property development group who were going to develop a property actually over in Spain, and we had someone else funding it. So they set up a company, the development group were doing all the work. They rebuilt this company in Spain, a massive property for a few £1 million. And then this other company put all the money in. So they were going to share the profits 50-50. One did the work, one funded it. So again, there's many types of joint venture structures that you can look at. Profit participation loans is another one, which actually was in that example I just said. The funder lent the company a few £1 million. Their loan said that there was something like a 7% default. I'm not sure if I've got an example on this actually. No, I haven't. But there was a default if for any to cover them for any interest. But the main thing was they called it interest in the loan agreement, and that's what I was asked to advise on, whether this was genuine interest, because the interest was actually 50% of the property profits. And if you want to know the answer, I decided it was not interest, and for tax purposes, it was actually a profit that the funder would pay tax on rather than interest income. And where we can see some really, really complex group structures is where we talk about mezzanine finance, where you might have a number of different layers of debt going into a property group. And depending on who the debt holders are, they might want priority. And so you can actually end up with sort of holdco owning midco, owning subco, owning tradeco or propco at the bottom, and then you've got loan notes going into each, and all really for legal purposes, but you've got to be careful of the tax implications of that. So simple company structure, we've got propco 50-50, single class of share, ensures the profits are split equally when the development's done, or when the property's sold, or when dividends are paid. They get 50-50, and essentially having one class of share protects them. I do have a slide on the example I was just talking about. So FinanceCo there, you can see they lent £2.9 million to the propco. The holdco are the ones who did all the work, and they basically said the loan was their way. So the FinanceCo in this example owns no shares. Holdco owns 100% of propco. But as soon as that development is done, that's when the loan becomes repayable, being the loan amount plus 50% of the profit that it's sold for. So again, there's so many different ways you could do this. In this case, we've not got the 50-50 shareholding, we've got 100%, but a loan, and because it's a loan, it ranks in priority on a liquidation to the shares anyway. Groups, I do want to spend a few minutes talking about this, because we often get people come to us saying we do a bit of everything, this is our company, and you know, we want to sell the furnished holiday let business, or we no longer want to be involved in commercial, so we want to sell that off. And so a lot of the work I do is about, can we demerge and sell one of them? It can be quite difficult, because again, we need HMRC to be happy we're doing this commercially and not just to get a bit of a tax break. But what I will always warn against when we're talking about a structure like this, where we've got all types of property in there, we've talked about how development is trading. We've talked about how furnished holiday lets is trading and can get 10% business asset disposal relief if you sell. In this company, you probably can't get either, because you've mixed it up to be trading and get those reliefs on the shares, you need to generally be around 80% or more trading in nature. Here, we've got a whole mix, maybe it's 50-50. What we've done is take some trading activity, some non-trading activity, and completely remove any chance of having those trading reliefs. So not a great structure, but it often comes up that they've just reinvested profits as they've gone through the years, and they've just kind of done a bit of everything. So one way we could resolve that, actually the way we would do it is put a new holding company on top and then move things around within a group. Generally, if you're moving companies in a group, moving properties in a group, you get group relief for stamp duty land tax, so there's nothing there, and you get capital gains tax group relief as well. So as long as it stays in that one group structure, you can generally do things tax-free. But you need to be careful. If you then go and do something in a few years' time, you can trigger what's called a degrouping charge. So if you do this, set this up, and then move FHL Co out or something, or maybe say we're going to move that into a separate group, those gains and potentially that SDLT comes back into charge. So it's okay within the group, but be careful. It can be up to 6 years and before you're out of the woods for one of those degrouping charges. Some of the benefits of doing that are, you might say, well, we want to sell, but we want to reinvest in, let's say we're going to sell FHL and we want to invest in development. So there are circumstances when PropCo could sell FHL Co, it's Furnished Holiday Letting shares, and pay absolutely no tax. It's called the substantial shareholdings exemption. You need to be trading, so this would only work for development companies and Furnished Holiday Let companies. So it needs to be trading. You need to hold the shares for at least 12 months. So you can't just do it and then sell the next day, but it's a potentially beneficial structure to be set up like this. Again, because we're within a group, it's not too onerous to be transferring cash between group companies without any tax issues as well. So that's one way to set up a group. Sorry, just jumping back to that, the issue we still have, if we wanted to sell everything and liquidate, or we wanted to just sell the shares of PropCo, we're still tainted. PropCo owns shares in trading companies, it owns shares in investment companies. So we still have a problem with those reliefs like business asset disposal relief. If we want to gift some shares to some children, we can't get gift relief because we're not trading. So this might be a better structure. Instead of having it all within the one group, have them separately. We've now got a development co and an FHL co, which are both trading, and we've got two companies which aren't trading. So the FHL and the developments can get things like gift relief and business asset disposal relief. And obviously we just have to accept that the other two don't, but we're in a much better position now. The other thing to be aware of is, and this happens with development companies a lot, why they set up individual companies. If someone comes along to buy that property, they could say, it's £1 million property. Instead of paying, even if it's a commercial property, instead of paying SDLT at non-commercial rates, we'll buy the shares directly from Dean and Julie. So Dean and Julie pay capital gains tax, but it's a trading company, so potentially they get the 10% rate. The buyer only pays 0.5% because he's paying stamp duty and not stamp duty land tax. And the company, which has developed it and presumably sitting on a nice gain, doesn't pay corporation tax because we've sold it at shareholder level and not company level. And that's why you can see structures where, you know, people have one company for each property, because it means that they have the benefit of selling without incurring that gain. Obviously, that might, in the negotiation, effectively that gain is rolled over to the buyer. So the buyer might want to reduce the price a bit to compensate them for that. But certainly worth considering, and a big one for development companies. If we're looking at a development group, and I have quite a fairly sizable one, they've got 15 companies all within a group. And the question to me is, we're not trying to sell, we're going to keep this and I'm handing this down to the kids and the nieces and the nephews in the future. All I want to do is keep going. I want to sell Development Co. 1. I want to take the cash. I don't want to pay any tax on that, because everybody who comes to me says I don't want to pay any tax. I just want to put that back into another project, and I'll just keep doing that roll over and roll over. Right, he's at about 30 million now, so he's doing something right. But the point is, he can quite legitimately do that, because he's selling. In most cases, he's using it as a bargaining chip to the buyer to say, buy the company and not the shares, and you'll save yourself the SDLT. Some of them he's developing commercial, some of them he's converting commercial. He's converted a bank into a residential property, and he was telling me how he's about this massive bank safe he was trying to remove, and he ended up blowing it up. So it's a bit crazy. But so the tax benefits here are, going back to that substantial shareholdings exemption, for trading companies, the tax rules say if a company sells a trading company, which is held it's held at least 10% of the shares for more than 12 months, then there's no corporation tax on the disposal. And the reason that is such a beneficial relief is the government's trying to encourage companies to reinvest. So the fact that Holdco, let's say Development Co, sold for £5 million, Holdco now has £5 million, which it can now reinvest in another project, which is what this guy's been doing, just developing, selling, having all the cash and just putting it back in. And it works perfectly fine. There's absolutely no issues with that, even though it seems a little bit too good to be true. But it's a really, really beneficial structure. Obviously, the reason it sounds a bit too good to be true, how I've just said to you, is that at some point, either the kids are going to get it, which is great, other than there's a massive inheritance tax problem he's got at the moment, because £30 million inheritance tax at 40%, he needs to do something about it. Or if you're not looking to pass it down to future generations, at some point you're probably going to want to retire and run off into the sunset. So you, at the very best, capital gains tax, almost all of that 30 million is not going to be at 10%. You only get £1 million at 10%. So you're going to pay 20% tax when it all comes out at the end. So, you know, the government's not completely losing out. It's just you're keeping it within that corporate structure. And that's me done. A little bit over time, but hopefully that has been useful to explain kind of the types of things that are available, the types of things that sound good, but when you're talking about incorporation wipes out any tax savings you'll get as a company, what you can do if you are already a group, all of those types of things. There's so much, and I've tried to cover a lot in a fairly short period of time. And hopefully I've kept most people interested, even though it's 9:05. But if there's any questions, then please shout. If there's any questions already through, if anyone wants to come off mic and talk, we're here for another 25 minutes.
Yes, we are. Yeah. Just to summarize the very first thing I said, when most people were already in, it's a matter of becoming aware of these things, and that these possibilities. You can't possibly learn this or decide your own tax planning during a webinar, or hope to even do it tomorrow after this event. It's like with any other advice you need, whether it's legal or medical or surveys or mortgages. You have to be prepared to take advice. And if you need advice, and this is talking generally as somebody who's been involved in the professions for so long, if you need advice and are prepared to ask for it and to pay for it, it's probably indicates that you do need it, that your financial situation is substantial enough to need to consider these things. I do realize that when people are starting off in property, or have just recently started, that their property portfolio is not, and business portfolio is not that big yet, but it could become so. and therefore you really want to set it up in the right way. So I know that is a dilemma for a lot of people, but you can't run before you can walk. Um, um, so to ask a few questions in a way of, to some extent, summarizing one or two of the points you made, Nick, and one or two questions that have come in. I know you probably don't deal all the time with trusts. At what point would you suggest, trust, and where would you suggest trusts start to become worth considering?
Yeah, I mean, actually, it's interesting because asking me a question about trust, because I almost provide the tax planning of how not to use a trust, because I talk about family investment companies and how we can use Alphabet shares and Growth Freezer shares. Trusts, I think, certainly over the last 10, 15 years have become less and less beneficial from a tax perspective. Where they really have value these days is in the protection. So for instance, minor children holding shares is a big no-no. Whereas obviously if you have a trust and you want minor children to be able to benefit, then you can absolutely set up a trust to hold the shares, and then it's up to the trustees to be able to distribute any income. For instance, if you want to pay school fees or something, then the trust can distribute funds each term, or however often school fees are paid. So I mean, there is still value in trusts. It's just, I think the tax rules have changed over time that mean they're not quite what they used to be. I would say in terms of tax planning, trusts versus an FIC is probably a question you want to consider. As you say, Clive, I'm not a private client expert. Trusts is definitely not my area of expertise, but at the same time, if I'm looking at estate planning, I won't do estate planning and talk about an FIC Growth Freezer share structure without having a private client specialist covering whether a trust is at least something that needs to be added to my report or whatever. So I think they're definitely worth considering, but if tax is your sole reason for them, then you might find that you don't get the benefits that you once could have got.
Okay, thank you. In terms of joint ventures, this is something that's quite popular within property, of working with other people where both have, as we call it, skin in the game. Just summarize again how you see limited companies, and in particular groups of companies, working for two people who've no other connection other than a business connection.
Yeah, so when we're talking about JV cos in that sense, I think typically they are set up as limited companies, especially if we're talking about development, because there's obviously more risk involved there. And there's a lot of different things you can do with share capital, and in the articles you can include protections for both parties. If one leaves, or heaven forbid, if one dies halfway through a project or something, what happens to their shares? So the way you can set these things up, you might have different classes of shares. If, as I talked about, if someone's putting more funds in than the other, we can look at whether they do that as a loan, possibly a profit participation loan, or whether they do that as preference shares. Preference shares have their own benefits in terms of inheritance tax as well, but what a preference share is similar to a loan, except for the fact that it's share capital technically, and they obviously rank in priority to the ordinary shareholders. And yeah, so we can look at whether this is a single company, whether this is done as a joint venture, so they've both got their own limited companies above, and it often depends on what their existing structure is. If it's just somebody's got some cash that they want to invest, they might be talking about a profit participation loan. If in one of my examples, it's actually a big property development group that are going to do all the work, then perhaps they'll take share capital as a part of it, and the plan will be to liquidate at the end of it. So yeah, there's a lot that can be done. Profit participation loans and mezzanine structures are fairly common in the property development world.
Okay, thank you. Can I just encourage anyone who has got a raised hand to write their questions in the chat for two reasons. Basically, it might be easier for me to ask the question, but also if we do run out of time, at least I've got a record of the questions and we can try and answer them afterwards. Yes, I would summarize the point at the very beginning. It probably helps with one of the questions that's been asked to that a limited company might be used more for people who are in what I call growth mode and are not taking the income out.
Yeah.
Whereas sole ownership might be used where you do want the income. Although, of course, Nick, you did put up the comparisons between where even income can move in and out of a limited company. Certainly having enough income in sole name to use up your basic rate bands, would you consider that to be a reasonable approach?
Yeah, I mean, it's another example I had. We had a client who was they were actually a trader. They were in the retail market selling products to Dunelm actually, but they had a decent property portfolio, and they came to me wanting to incorporate it. When I actually went through the structures, with the cost, and there was going to be tax charges to incorporate it, they had a need as a family for £100,000 a year as income. So actually their best route was don't incorporate. You're making about £100,000 a year anyway in your property portfolio. So live off of that and leave all your money in your limited company, and then at some point when you retire, you can take that out. So again, it depends what else they're doing, but it's interesting that they kind of assumed we're going to live off the trading business, and we want to leave everything. We want to grow the property portfolio.
Yeah.
So yeah, it's important to consider all aspects there, but what the advice there was, well, you need 100,000. You're already generating that, so any new properties you do, those you can put in a limited company and roll up the cash and reinvest, etc. So they've actually ended up with essentially three structures. They've got their trading limited business, they've got their property partnership where they effectively live off those funds, and the new money or the money they're making in the trading business, they're investing in property in a separate company. And again, the advice to them was do that in a separate company, not in your trading group, because you're going to taint your trading status for your reliefs. So they've kept those two separate, but at least they can they've got the best of both worlds, basically.
Okay, thank you. Possibly a question for a broker, but you may have experience here. And I do know from an experience of another one of our friends in this group that there can be issues, problems. Any issues with lenders if you have alphabet shares models, especially with minor children?
Yeah, there probably is one more for a broker. There's certainly issues with lenders when we are moving the properties, even moving properties within the same group. We've often the finance is one of the keyest the key issues and the key stumbling blocks, if you like, especially at the moment. If someone's on a good deal and they say we're doing a restructure and we're moving this property to another subsidiary within the same group, you know, that's the first chance that the banks get to say, well, then we need to do a new mortgage agreement, and we're going to charge you an awful lot more interest in this climate. Alphabet shares, I think there still can be issues there. I mean, if you're talking about minor children, that's where you might actually have a trust holding those shares, or at least having someone holding it on bare trust, which means it's in the legal name of the parent or the adult. But certainly you need to be careful when you've got a property group and mortgages that, you know, the mortgages probably do have terms in there. I mean, they might even have personal guarantees, and the bank's not going to be very happy with you changing the share structure without their permission. So yeah, definitely one to be aware of and review your mortgage agreements at least.
Yeah, absolutely. Yeah, it was a good question, useful question. I do know there can be issues, and I do think you need to check with your broker before you do do that. Can you just summarize, perhaps just again in without the slides up to add to the complexity? Because a very popular question is whether to keep different types of property, BTL and HMO being residential, and FHL serviced accommodation being the other category, and then commercial. To mix them or not mix them into one company, to keep them the three strategies within separate different companies, or even each property within a company. So popular question. I know you talked about it, but I think it's useful to, if you can, just to summarize it in a minute or two.
Yeah, I'll try.
Terribly difficult one, I know.
So the main thing is, if there's a trade, if one of them qualifies as a trading business and one doesn't, you want to keep those separate.
Yeah.
You might have issues when it comes to funding. If one business is making a lot of cash and you want to then fund a different business, generally you can lend between, even if they're in two completely separate groups and you just own the properties and the companies individually, you can lend money between the two. But if you actually want to write those loans off, then you can have tax issues. So be careful lending money between the two and writing loans off.
Yes.
Always try and keep a trading business trading, and don't taint that with non-trading assets. If you are looking to if you're looking to do things like develop and sell,
just a little louder, Nick. You've just gone a fraction quiet.
Having a development group can allow you to benefit from the substantial shareholdings exemption to pay no tax. So development businesses having subsidiaries under a holdco can be very, very beneficial. But yeah, I think my main message is trading and non-trading keep separate. If there's any other reasons like commercial liability, you might also want to keep separate. So for instance, I probably wouldn't merge a development company with an FHL company, even though they're both trading, purely because if anything goes wrong on the development side, you might have a problem, and someone might be able to have a claim on your FHL assets. So be careful of that as well. Keep development business, I think, entirely separate.
Okay, Nick, just when you now answer the next question, it's just that particular one. You went a little quiet. Perhaps you've moved away. So sorry if anyone didn't quite catch that. I could hear it, but it was a little harder. We've only got a few minutes left, so I'm just checking the questions. Somebody asked whether there's any particular problem with starting their property journey in
I don't know if it's just me, if it's me or not.
Sorry? Yeah. Can you hear us, Nick? Have we lost Nick?
Stop share.
Yeah, have we lost you, Nick? Nick, can you hear me? Oh, sorry. You can't hear me. Oh, how strange. Can anybody hear me? Raise your hand if you can hear me.
Yes.
Right, only
Can
Nick.
everyone hear Clive and not me?
Okay. Oh, can we all hear Nick and everybody now?
We can hear both.
Yeah, great. Thank you. Sorry, that was just
Thank you, Nick. Thank you.
one last question.
Clive.
Thank you. Yeah, Paul was
Can you hear
asking
me?
any. Yeah, we can hear you, Nick.
No, still can't hear anybody.
Oh,
My speakers are definitely working. Recording mute.
headphones may have unplugged. Ah, have a look. He can't hear me to tell him. Look at me, Nick, and I'll do a sign for headphones.
I can hear you. I can hear you through. Can you hear me?
Yeah, we can. Perfect.
I don't know what happened there. I've literally not touched anything. I've changed you to my laptop speakers, so hopefully the sound is still okay.
Yes, we've just got a few minutes, but we only lost you on that last answer where it was quiet rather than you weren't there.
Okay.
Yes, I've more or less come to the end of the questions. And in view of the time, I'm going to summarize really. Ian has asked or Cherry has asked a good question, I think. It's a more general one. So I'm going to answer that now as best as I can, and I think Nick can contribute as well. Let me just get. They've asked who would be the best person to advise on both legacy planning and property company structure, and how to find them, or tell if your accountant is competent in that area. Okay, well, I'm always very open and honest, and I think and transparent. It is difficult. I understand that we all struggle to find the right builders, the right brokers, the right solicitors. And we get recommendations and they don't work out for you, or they are great for you. And we assume who we go to unless we suss them out and we don't like them. So it's a terribly difficult game, and it's frustrating with anybody, especially professionals. There's an inconsistency. Anyone, please mute there. Thank you. What I would say is that you have to use some judgment. So, but Ian's asked outright. You can go to one of the 4 or big accountancy firms. I wouldn't recommend it. That's nothing personal, because I don't think there's probably anybody on this webinar or people I know that probably need that. And that would probably be the top 10 and 20 top 20 firms. You need to ask the person whether they know about this stuff and judge their honesty. I will always refer to a consultant like Nick to do the things that I am not expert enough at, and where I know that that's the honest and right thing to say to any of my clients or to any of you on here. When it comes to this very specialist advice, as Nick has said, he knows about trusts, but isn't an expert on them because he doesn't do them day to day. So there is probably no one consultant who can ever advise on all areas, just like there's no surgeon who can do brain surgery and ankle surgery. You have to go to the right person for the different specific disciplines. And the more complex it becomes, of course, the more you have to go to individual specialists, just like with your health, to use that example again. you can go to your GP and tell him you've got a sore ankle and a headache. But if he then needs to take those further, he'll send you to two different people. So it's a matter of sussing out your accountant and finding out what where you need to go and when you need to go for specialist advice. Nick, can you perhaps
Yeah.
just contribute to that comment?
Yeah, no, I totally agree. I think, firstly, if in any kind of tax planning, you at least want someone who is qualified, and you can look up people on, if they're a member of ICAW, they'll be on ICAW's website, tax advisors, CIOT's website, ATT. Some people are qualified by experience, so might not have a whole host of qualifications, but at least you'll be able to see that they have been. I would always urge somebody, if it's specialist advice, you need to go to someone who has got some form of accountancy or tax qualification for definite. And yeah, as you say, Clive, if someone is out there basically touting they know everything about the commercial aspects, the tax aspects, the accounting aspects, then either they're very good at one thing and not and don't do anything other than property. But in reality, I don't know anybody that you've got to be able to know your limits even as an advisor, and you've got to be able to be honest to a client if they say, as you said, Clive, you asked me about trust, and I was like, I can kind of give you the basics and might be able to hold my own in a conversation, but I'm not going to give you advice on it ever. And it's the same for VAT. I'm not, even VAT is more business related, but I still have absolutely no idea about it because it's a whole different ball game. So, and most decent advisors, I think, know where their limits are and know when to bring in other people. And most people who do kind of work in property, so if I work in property incorporation, I'm able to recommend people who can help on the other aspects that I can't. So if I need someone to help on trust, as I say, I've got 2 or 3 people, depending on the need and depending on their workload, I can go to and say, can you quote to help me with this report, because there's a trust angle to it. So advisors who can admit their limits to a client, I think, has some value as well.
Yeah, absolutely. And that, of course, is evidenced by the fact that I've invited Nick to do this particular webinar, whereas I have done other webinars myself, because they are within my sphere of work. We have turned 9:30. Sorry, it's bang on 9:30. So I think that's a great time to wind up and to thank Nick. And I won't close the screen before. Thank you for your applause there. I won't close the screen without capturing the questions, and we'll come back to the people afterwards. If anyone wants to talk to me or to talk to Nick, then just let me know. He did give his phone number and contact details, mention you were on the webinar. I'm more than happy for you to come through me, and I'll field the question that you have, or the situation you've got, and pass it on accordingly.
Yeah, I'm always hopefully seem approachable, but I'm always happy to help, even if it's not going to lead to any chargeable work. Even if you need a sort of a 10-minute chat through on something, then yeah, I'm always happy to help on this stuff.
Yeah, that's great. Thank you. We all appreciate that, Nick. So once again, thank you for at one point over 70 people being on tonight, which is a great number. So well done, everyone. It's hard work to take all that in at this time of night. You will get a copy of the recording. You can screenshot 1 or 2 slides as you want them. And you've got, where to ask questions. We've got the Tax WhatsApp group and me directly. So very finally, Nick, thank you very much.
Pleasure. Thank you.
Thank you very much. And I'll say good night to you and speak to you another time. And I'll say good night to everybody on the webinar.
Thanks, everybody.
Bye.